Hello and welcome to the Basic of Currency Trading webinar. Your presenter, me as a coach, Asfar Jamil, and this webinar is presented by www.capassets.com, and today we will be talking about the basic of currency trading. And the topics would be history of currency trading, what is traded, revolution of trading, margin trading, tips on MT4 or MetaTrader 4 platform, and trading plan, and also risk management. First thing first, we will be looking at the history of money creation so that we know what are we trading for and what the instrument that we are trading at. Right? It all began in 1792 to 1750 before centuries. Money and banking originate in Babylonia out of the activities of temples and palaces, which provide the safe places for storage of valuables. At that time, they are using the barter system, whereby you change one goods into another. But that type of transaction is not that secure and it's not that convenient for them who wanted to change, for example, one kettle of cow to rice. So that will be a little bit problem for them previously. So after that, they have created this rock carved on 640 until 630 before centuries, the earliest coin made in Libya, Asia Minor, consisting of electrum and the occurring amalgam of gold and silver. At that time, the currency or the money is created. It is uses for the measure of value, medium of exchange, store of value. So that it is more convenient for them who wanted to change stuff like variable stuff at that time. Okay, money throughout the history of the world, they started with the rock, and then they're using the shells, livestock, precious stones, skulls, pearls, feathers, brass, silver, gold, and paper money. And then we are using right now, which are the paper money. Alright, the most valuable things among all the medium of exchange is gold. So, gold as money is widely accepted, diversible, easy to measure, easy to carry, non-perishable. Although it wears out, but it is impossible to forge money, impossible to create the money itself. If the money is gold, of course. The demand for monetary gold is a function of economic needs. An expanding economy needs extra money. The demand for monetary gold competes with the demand of the industry. Example, electronics, medical equipment, space research, and etc. Money values are currently increasing, and sometimes uh, it also denies. It depends on the demand and supply of that gold. That's why we are more strictly ask our students to study the macroeconomic equilibrium so that they understand the price and quantity, the supply and demand uh, effects on the market. As well, the supply of gold is a function of which is the function of natural resources. Nature doesn't care if the prime minister wants to increase the money supply or not because they are limited. And that's why the value is not that easy to deny. Yeah. History of currency of trading. Currency trading now says foreign exchange. Today, currently trading is known as the Forex, the abbreviation of foreign exchange. So they took out the front two letters FO and FOR, three letters, sorry. Then the second syllable EX, so they put it together as Forex. So currency exchange will be manifested and uh, facilitate the traders, and they react on this changing of prices along the time, which influenced by the demand and supply, of course, and then other uh, other the effects that also affected the market, such as the interest rate news like non-farm payroll. So in the 15th century, the Medici family opened a bank in separate location to provide currency exchange. So they open up a white bank here and there in other countries so that they have their medium of exchange to buy goods and to sell goods themselves. And then in 1880, it emerged one of the first banks to do the business of foreign exchange, which is the Banco Espírito e Comercial de Lisboa. This bank began to appear in major cities of the world, and the most active are Paris, New York, and Berlin. As in forex trading, gold standard and Bretton Woods is the most important agenda that happens uh, previously, and this affects the currency value nowadays. Gold standard by 19th century, gold standard was widely used as a compelling financial system of any currency to the value of gold, has resulted in currency that requires a very large gold deposits. That means that sorry, that means that if the country have a big amount of gold deposits, they have the much more powerful power to control their government, to control their country, and to conduct their businesses. Some external factors such as discovery of new gold deposits, much of it influenced by the gold standard previously on that days. While approaching the First World War, instability and turmoil has affected the reduction of gold to anchor itself to the exchange, and because of that, they have printed more money than they usually do to finance the military projects that they have done. These military projects and war are most influenced by the demand of gold, because each of every country want to be powerful, so they want to conquer other countries' gold and to steal their gold, so that they have the gold storage uh, to be powerful in the world. Bretton Woods Agreement lacks. The lack of gold supply to support the world currency eventually led to the abolition of the gold standard. As the Bretton Woods Agreement signed in July 1944. What is the Bretton Woods Agreement? The main features of this Bretton Woods Agreement is requires each of the participating countries include their currencies to be pegged to the US dollar. Means each and every currencies around the world have to change their money to US dollar before buying gold on the market. In the Bretton Woods Agreement, US dollar is the most powerful currency in the world because you have to change your money into US dollar before you go and buy gold in the market. So USD is the only currency pegged to gold at that time. The establishment of this system then creates the International Monetary Fund, which is the IMF, and then also International Bank is funded. The purpose of these two firms is to rehabilitation and to development of the money itself. The Bretton Woods monetary system has terminated on August 15, 1971. The main reason of this failure is that only US dollar currencies are pegged to gold. Other currencies don't like it, so they want to buy the gold with their own money. Uh, that makes them a bit of problem when they have to change their money to US dollar. More or less like oil nowadays. Uh, most of the Arab countries only accept US dollars because of their agreement with the US. And other countries who want to buy this oil, they have to change their currencies first into US dollar before purchasing barrel of gold. At that time, the former US President Richard Nixon announced the termination of this Bretton Woods Agreement. And for your information, on the 15th of August 1971 that is the date of the first candle appears on our MT4. This is the historical data started from this day. It is important for us to know what happens on that day. So in conclusion, money is no longer has an intrinsic value. Money is only one medium of exchange, which is the currency that we are so called on. And it has a rate of inflation whereby the value of that particular money will diminish after such inflation occurs. In forex trading, what is traded? Before that, we have the forex trading introduction first. Before this, we have discussed about the history of money, how it's created, and then the revolution of that money. Before, previously we used the rock, the carved rock only, and then we use everything else after that: silver, gold, and paper money. So now we are talking about this paper money that have the opportunity to trade, to make money and to lose money out of it. Forex is the largest financial market in the world. Currency traded via the currency pair price, which so-called a spot market. Forex trading with a turnover of almost $4.2 trillion per day, far more than any other market in the world. Let us compare with the stock exchange. As you can see, the average trading volume for forex trading market is much more higher than the other stock exchange. For instance, the New York Stock Exchange, the London Stock Exchange, and the Tokyo Stock Exchange. They are so small compared to the forex trading market. It is an opportunity and a risk for us if you want to trade inside the forex market. So who is the participant in the forex trading market? Unlike the participant characteristic, personal forex trader individual which runs and manage their own small trading accounts online, like me or you if you want to start your own trading account. I'm sorry. A professional forex trader in a bank, they are big traders who took profit on behalf of the major banks they represent, for profit of the banks and other consumers. And also the international company or international corporation is seeing opportunity to protect them from exposure of a sudden fluctuation in foreign exchange rate, such as Apple, a big company. Apple do sells their stuff, create their stuff in US, most of their gadget, but then they want to minimize their cost and They conduct industry. They make their gadgets outside of their country. So if the currency rate exchange changes fluctuately, it affects their costs and also their profits from it. So they do have trading in their company so that they are covered and also to make some profit out of it. What is the currencies that traded inside the forex trading? The official currencies traded in the world, which is US dollar, euro, European euro, Japanese yen, British pound sterling, Swiss franc, New Zealand dollar, Australian dollar, Canadian dollar, and so on. The currency are traded in pairs. So all currency are we have divided the currency into two. The first currency that is stated up front is the base currency, and the second stated currencies at the back will be called as spot currencies. And these two differences between them, the value difference between them, will be stated as this price, which is the bid price. And then another one, which we call a ask price. The differentiate between that two prices will be called spreads. These currency pairs have their own nickname. Some professional investors often leave or call their pair with a nickname such as Fiber for Euro USD, USD Japanese with their abbreviates Yen, GBP USD, which they call Cable, Australian dollar, Aussie, US dollar and Canadian dollar, Loonie, and also the Switzerland franc, they call it Swizy. You will hear these nicknames often in the news and also in the article that they have inside their websites. Before we go further on the margin calculation, you have to know what is the currency price value. The price in the currency have very high liquidity up to 5 decimal point. That is why they have their own name for each and every decimals. 1.00000, which we call $1, we can use it, we often use it in a daily basis because they have money printed as $1. 10 cents, we have a coin 10 cents, 1 cent. How about the third decimal? We call it the movement as 1 point, and another 1 decimal after is 1 pip. 1 pip is percentage in point. Another one which have been recently used for all banks after 2007, 2008 if I'm not mistaken, by the President Bush. He opened another decimal point which is called 1 fractional pips or pipette as a short. This movement of 5 decimal point is much more fluctuates, much more liquid than the stock market, which only use the third or the fourth decimal point. That is why the forex market is really liquid. What is the contract value of the forex trading? We trade our forex market using a standard lot size for direct STP brokerage and the pip movement. This 100,000 units is equals to 1.00 log. That is equal to $10 per pip movement. We will also have 10,000 units and 1,000 units. Depends on the setting of your brokerage. If your brokerage have a standard account and they can open up to 1,000 units, That means you are able to open up a position of 0.01 lot, which equals to 0.10 US dollar movement per pip. As you all know that we said before, we trade the forex trading as a bundle, as lot. One lot is equal to 100,000 units. This is for an example. Wholesale market will only sell the eggs for 12 dozen or 30 eggs, then cannot be purchased separately. Forex too, we cannot buy or sell contracts of €1 or $1 only. If you want to change your money €1 or $1, you can go to the money changer around you. But in forex trading, we have this contract that we normally use as 100,000 units standard lot for one lot, 10,000 units for 0.1 lot, and 1,000 units for 0.01 lot. The rates are varied. It's different between brokers and account type. Let's say if you want to start trading, you don't have to deposit $100,000 if you don't have that amount of money, because brokers often offers leverage. It helps you to open up a bigger amount of trade volume, which is 100,000 units for one lot, so that you don't have to deposit a big amount of money to trade. Let us define what is leverage. Leverage allows a trader to make a small deposit but control a large contract value inside their trading. Higher leverage is not suited to everyone. It depends. Higher leverage means you are susceptible to large losses as well as gains. Here, for example, giving you the purchasing power to buy or sell big contracts and execute greater trading size. For instance, this margin capital of 12.5 US dollar with the leverage of 400 to 1, you will have the purchasing power of 5,000 units of contract. 5,000 units of contracts equals to 0.05 lot in lot cases. Alright, let's see what is this margin calculation for. The margin calculation you can see inside the trading platform. Our trading platform is MetaTrader 4. As you can see here down below, the balance mentioned are the balance of your account after previous trade. This is what you can see inside your trading account. Equity are the balance deducted by floating. Let me show you an example. But before that, if you want to jot down, you may jot down these slides if you want to. Okay, let us open a trading activity right now. As you can see on your screen, I've opened up a GBP USD 1 hour chart here. If I want to open a position, I may click for the new order over here, up here. And then make sure that your symbols is the same as what you are trading for, because more often people make mistakes if they scroll down here. Then the volume. Volume is the lot size, meaning that 1.00 volume lot size will be the same as 100,000 contract size. Let's say if I want to open 0.05 lot out of this trade, I want to enter the market execution. You can click the buy and sell button if you want to buy or sell the market. Let's say I enter a buy trade here, and then I will see balance right down here, and then follow up with the equity, margin, free margin, and margin levels. What are those for? Those are the calculation which we have discussed previously. Balance is the balance of your account after previous trade. Equity equals to balance divided by floating. Let us see. Equity is equal to balance divided by the floating amount over here. If the floating amount equals to negative 0.30, meaning that we have deducted the balance, the floating, and we have a loss over here. If the amount right here, amount of the floating right here is in positive positions, means that you will have a positive amount of profits inside your equity. Right now the equity will increase and decrease by itself, but after you close the trade, the equity will be your balance of the previous trade. Okay, how to calculate the margin? Margin equals to contract size divided by leverage. This account that I have opened consists of a leverage of 1 over 500. So if you open 500 leverage, contract size depends on your lot size, and you divide it by the leverage and you will get the margin per lot. It will be added if you open another position. Next, free margin is equals to balance deducted by floating and divided by margin. Free margin is the amount that you can open for the balance amount that you will have the opportunity to open for the next position. Lastly, the margin level is equal to free margin divided by the margin, and it is often counted as a percentage. We have to know how to calculate this margin level so that we will always be prepared for unexpected price movement inside the market. What is the advantages of forex trading? The potential benefit of two-way market, which we can make money either way if the price falls or rises. The size of capital, risk, and determine your own profits and transactions. Can trade anywhere with an internet connection. You have flexible time for the market 24 hours a day, 5 days a week. And start with a low initial capital of $50. It depends on the brokerage that you are choosing. Some broker offers $10 for a minimum deposits. No need to search for any downline. This is not a multi-level marketing MLM. No. It is not involving marketing. It's not involved with selling or promoting. So you can focus on your own money, on your own trade. Sorry. This is not a get-rich-quick scheme or high-yield investment program. This is a long-term journey for you to make money. Alright, first thing first, we will look at Forex, compare Forex with the stock market. There are approximately 4,500 stocks which is listed on the New York Stock Exchange, and 3,500 from those are listed on Nasdaq. Which one will you choose to trade? You have to distribute a lot of time analyzing these companies. So it will make you, maybe if you make the analysis, it will be late and you will pass out for the movement at that time, because you have to make a much more analysis. Who is the president of the company, the accountant, what do they buy, what do they sell, what do they do. It is much more work that you have to do to analyze that market. Might as well in spot currency trading, there are only dozens of currency are traded in national currencies. Four pairs of currency choices for the majority, which is Euro USD, GBP USD, Aussie USD, USD JPY. So we take the advantage of forex market on the stock market. More focus, we have more focus and more time on some currency pair versus the 5,000 shares that listed inside the stock market. The market is open 24 hours a day, 5 days a week. So you can choose your time, when and where will you trade your account. The minimum commission rates or no commission charges at all depends on your broker. You have an instant execution. You don't have pending execution like the stock market. If you want to close, you have to wait for a buyer. For example, short-term trading without interruption uptick. You can open and close your trading minutes, within seconds. They have no middleman to control your order, and speculators, brokers do not affect the market prices because it is an open market, and people will always use paper money to do their transactions. 34 hours of forex trading. This is the table of market open and closes, which is much more high liquidity when they are overlap on each other. When London and New York overlap with each other, that is the most liquid time to do your tradings if you are a scalper. Scalper is a type of trader who trade in the short term, where as well, meanwhile, the long-term trader are more often called a swinger. In forex trading, there are no commission charges. It means that you can minimize your trading costs during your trading. Unlike other markets, foreign exchange have no government fees, no brokerage fees, no exchange fee, no law fees whatsoever. Instead, brokers are only charging you a compensation of their services called spread. That is the difference between the bid price and the ask price. On the chart, as you can see, the bid and ask will be stated for each and every currency pairs offered. With Forex, you are able to practice without risking your money. You can use the demo account for your practice. Most Forex brokers online offers this opportunity to open up a demo account and start investing, start your trading. You can build up your skill, enhance your understanding of how the market moves before continuing to plunge into the market with your own hard-earned money. Demo accounts allows you to invest to trade in the issues of Forex news in real time and using a wide range of graph pair and investment aids, investment tools such as indicator, just like what happens in a real account. it is as same as the real account. So you can practice out before you put down your first money inside the account. MetaTrader 4. We are using this platform uh, as our platform to make out our trading. This is a tips from us how to enter the FX market. There are four types of entering the Forex market. First one is the opening the market order immediately, which we call instant execution. There are also some pending orders that we can use: buy stop, sell stop, buy limit, sell limit. And also the third one cancels other. One cancel other usually uses inside the stock market, whereby if one pending order executes, the other one will be automatically cancelled. Depends on what you ask for. And last one is good till cancel. Good till cancel more often used if you are outstation. Let's say if you want to enter a buy order inside the market, at that time you don't have a time to look at the charts uh, more oftenly, so you just let an expiry date for that particular order, and then you can go do what everyone will what we do in the order. If the price does not reach that order that you have put, and then the order will be automatically cancelled out. So how to enter the forex market? The first one will be immediately instant execution. It means that we are entering the trade at the current market prices in that particular time. Just press the buy or sell button in your MT4, just like I showed you just now. And then the second one, the pending orders: buy stop, sell stop, buy limit, and sell limit. They have their own name because they have their own features. First one is buy stop. It always plays at the higher price than the current price. You want to buy at a higher price than the current price. That is when you use the buy stop. How about sell stop? You want to sell at the lower price than the current price right now. So you put the sell stop. Buy limit. You want to buy lower than the price right now. And also sell limit. You will always place it higher than the current price. If the market price does not reach the price level of orders that you have set, it will not trigger the opening position in the market. We have talked about how to enter the market. Now we will see how to exit the market. After you enter the market, then you can choose these four types of how to exit the market. Firstly, you can close the market, the order that you have entered, instantly using this instant execution. Just click on the close button. If you don't want to exit the market at the current price after you entered it previously, so another way, then you can put a stop loss position. It is an order used to limit your losses. For example, we have an open buy position and we place a stop loss 30 pips lower than that level. If the price drops 30 pips, the stop loss will automatically triggered and the purchase will be closed with a 30 pips loss. Let me show you an example. I have opened this position, a buy position over here. If I want to make a stop loss 30 pips down here, 30 pips, Then I just click on modify. That is my stop loss. If the price go below than that level, then I will not lose more than what I have set over here. Alright. Next one is the trailing stop loss. The difference between trailing stop loss and stop losses is behind the price movement. Stop loss movement, stop loss will not move if the price goes your way. Might as well in trailing stop loss. Trading stop loss will follow by the amount you set and log in the profits. In the losses or profits, if the price move on your side. If the price move in the opposite direction and it triggers the trading stop loss, the trading will be closed in the event of profit or losses. Depends on what you have set. Yeah, as a reminder, trailing stop loss will not be affected if you have closed your personal computer, your handphones, your PC or your laptops. You have to online 24 hours. You have to open your trading platform 24 hours so that this trailing stop loss will uh, do their jobs. Right. Next is take profit. Ways of ways of exiting the market highly favored by all forex traders. Setting a TP order in which we decide to take advantage or to take the rewards. The close of trading of the price level that you have set at that price trigger. So you can set the level of TP after you enter the trade. For example, I show you an example over here. We have set our stop loss here. We don't want to exit at the current price. We want to exit if we lost 30 pips over here. If you want to make a positive amount, positive exits, so that is called a TP or take profit. As you can see over here, it is shown here as TP. My advice, if you want to make a trade, make sure that your take profit is much more bigger than your stop loss. If your take profit is smaller than your stop loss, that means you have a bad planning. Okay, let's say if I want to take this at 40 pips here, 40 pips, 40 pips here. So I can change my order. Click on this modify button, click OK. That is my take profits. If the price goes up and touch that level, my order will automatically close. Now we have learned about how to enter and how to exit the market. Then we have to plan our trading. We have to learn money management skills. I will show you some of my own money management skills after this. But before that, we have to know forex trading is a eventualities and possibilities. So means that we are playing with probabilities. Either the market will go up and down, or we go buy and or we go sell. Losing is a part of trading. If you cannot accept loss in trading, means that forex trading is not for you. So you have to learn to control your trading activities. There is no perfect system that can give you 100% accuracy. That is why we have to give ourselves a little margin for error. Moral of the story, please put your SL stop loss on every trade you do. Okay, this is an example of my own money management activities. For instance, if I have a $200 balance in my account, I will make a risk based on 5% on the balance. For instance, this $200, the balance that I will take a risk of 5%, which is $10 over here. If I lost that $10, my balance will be $190, and then I will take another 5% out of that $190 into my trading as a risk. So after 20 consecutive losses, I will still be able to trade because my balance is 71.70. I can still open another trade after that. What happens if it goes my way? First thing first, I will also take a 5% profit reward per trading. So for this example, first one, I will take a profit of $10. I will set inside the trading system, and then I will get a 210 balance after that profit, and I will continue on using the 5% 5% from the balance, and then the profit will be $10.5, and I will continue this up until 20 times of consecutive continuously profit. The balance will be double from the initial balance that you have deposited. That means you are making money. That's good. This is the summary of what we have discussed. Initial fund of $200, discipline trade, it will make you to double the profits. $505, $305 profit out of the initial fund after 20 take profits. How about loss? 71.70 after 20 losing streak. That's a bad idea. If you do not put any SL at your trade, your balance will be gone. Can be done as soon as possible if you did not control your money management. Money management strategies suggested for a small and medium-sized fund. Follow this strategy consistently so that your fund is safe. This is another money management skills that I will share to you. If you want to have a monthly salary of $1,000, please make sure that you have $11,000 from the beginning. So you can withdraw that $1,000 and you can use that as monthly expenses. Then the $10,000 will be traded, and you just have to search for 10% monthly profits consistently, so that you can withdraw another $1,000 for the next month. If you gain more than 10%, you can withdraw the balance as your monthly bonuses. Let's start your trading today. Success, because you too can own this phase of pure accomplishment. Thank you for attending our webinar today. This is a Q&A session. Thank you again for coming. I'm your presenter, Asfar Jamil. My contact number is 01282120018, and my email address is asfar@cap-assets.com. See you guys later for the advanced webinar. Thank you for coming.